get back to Diane in New York, I wanted to do a quick market check here as we are still higher in 3 of the 4 major indices. S&P is in the last, 5 minutes or so, slightly dipping, but we are still seeing consistent weakness now in the NASDAQ, down about 1/10% on the session. Today's strength still led by the Russell, up about 0.5%. So markets fairly quiet as we are now roughly 19 minutes away from the Fed rate decision, I guess. I'm already pricing in perhaps a cut, but now kicking it back to Diane King-Hall, who is joined by Ghabour at the NYSE. Diane, back to you.
All right, I want to bring in Eddie Ghabour, owner of Key Advisors Wealth Management. Eddie, thank you so much for joining us this afternoon.
Absolutely.
All right, Ginny just talked about the Fed decision that everyone is anticipating. We've seen the market cool a little bit, still hanging on to gains largely ahead of the decision. When I just checked the CME Fed Watch tool, odds still, consensus view still more than 98% that the Fed will do a rate cut today. First up, what's your expectation?
I think the rate cut is definitely going to happen. They're not going to want to surprise us with no rate cut. I think the biggest thing today that investors are going to pay most attention to is what Chairman Powell says during the press conference and what future rate hikes look like or cuts look like as we go into 2025. I think one of the things that he should really emphasize is that the economy is strong enough that it probably doesn't need any more rate cuts. But if we do need cuts, they'll be there to help out. And I think that's a way you can balance it, because I'm concerned that they're putting too much stimulus into the economy with these cuts that will cause inflation to really accelerate next year.
You make a great point, because recently when we got both CPI and especially the PPI print, we started to see some warming back up when it comes to inflation. So that's cause for concern. And then now we've got PCE coming out this Friday, and the expectation is for that to come in a little closer to, still with a 2 handle on it, but too close to 3% for what the Fed's taste would be. It seems to be there is starting to be some ratcheting back of expectations for rate cuts for 2025, more conservative expectations when you think about the beginning of this year and how it was quite the opposite. We had at the beginning of this year, the end of last year, if we go back a year, there were all these expectations, 6 rate cuts, 7 rate cuts. There were even some who expected more than that. Do you think the conservative view is the right take for 2025?
I think we should not think of any more than 1 to 2 cuts next year. Because if they cut right now, that means they cut 100 basis points in 4 months in a non-recessionary environment. That has never happened before that I've been able to find. Normally, when you're cutting rates, it's because the economy is really falling off of a cliff and it needs stimulus. Cutting rates in itself is inflationary. That's why they do it when things are slow. So, look, if we only get 1 or 2, but the economy and fundamentals are strong, I think the market's okay with that.
The economy has held up better than expected, and we've had data point after data point being stronger than expected. We saw some pockets of weakness this year, but nothing that ever, kind of materialized to show a pattern of weakness, especially when I think back to the job market, when we got those numbers at the end of the summer, the July numbers in August that we got, which were weak. Then we had some other weak numbers, but those seemed to be, just kind of a one-off when we thought about the strikes and storms that affected the September payrolls. Is your view on the job market that we'll just continue to have a robust job market, or are there pockets of weakness that you've been paying attention to?
I think there will be pockets of weakness, but I think it's all tied to really what happens with interest rates. What's interesting is ever since they started cutting rates, the 10-year bond has actually gone up. And I think that's the bond market showing the concern for inflation accelerating. So I have a theory that if they don't do any more cuts, the bond market might actually cool off and keep rates down. That's good for real estate. That's good for people trying to refinance. And that's good for consumers. Because my concern is we're going to see over 5% on the 10-year if they keep going on this path. And that would be a headwind to the economy, to the consumer. And when you pile on a strong dollar on top of that, that's another thing we're watching closely.
You took the question right out of my head. I was going to ask you what's the number that's the risk factor for you with regard to the 10-year. But let's talk a little bit about then portfolio positioning for 2025. Where should the concentration be? Because we're seeing, all these outlooks for 2025 come out from different bulge bracket banks. And then the consensus seems to be the return to what worked, the Mag 7. What's your view on what positioning should look like or what your setup should be going into 2025?
So right now, our playbook is the market is actually very narrow in regards to what is strong. And we have pivoted in our tactical strategies, and we are staying with that narrow market until the broadening shows. And what I mean by that is we are overweight mega cap tech. We have consumer discretionary. We have small caps. And of course, we have some exposure to the SPY and the S&P 500. But we've gotten rid of healthcare, consumer staples, real estate, utilities, and our tactical strategies because those areas actually have not been performing well at all. So this market's going to stay narrow because I believe we're going to be in an environment over the next 4 to 6 weeks that shows the economy actually accelerating and inflation accelerating. And when that happens, you want to be out of defensive areas and more in offensive areas.
I want to dive a little deeper into small caps exposure there. How much concentration would be recommended, especially we've started to see, the Russell come back this year, had been trailing the other benchmarks this year, but post-election, you saw more gaining steam there. Also, some of that started to occur when the Fed started to cut rates. Obviously, that would be helpful to small caps. What's the risk that you see when it comes to small caps in 2025?
So what's going to be the biggest risk to small caps is if we do get that 10-year really go up through 475. Because there's a lot of regional banks, as you know, in the small cap index. So we have doubled our small cap exposure right now and heading into 2025. But we do think there's a tale of two stories of 2025 where we're going to have a strong start to the year. But I think that this air pocket, because of inflation accelerating, I just think, unfortunately, the Fed has miscalculated, and I think it's going to accelerate, and the 10-year is going to blow through 475 and get the 5. So I see a scenario where we see the market really have robust and animal spirits going through January in the first quarter. But I see an air pocket that could cause a 15 to 20% correction and starting sometime in the first half and then recovering back because the market is not pricing in a 5% 10-year or 475.
Okay, that's the takeaway that stands out to me. Strong start to the year, but watch out for air pockets, so buckle up.
Absolutely.
All right, that's Eddie Ghabour, Key Advisors Wealth Management. Thank you so much for joining us, Eddie.